Hi folks, Scott here, and this is the wrap for Friday, November 8th. Wow, this was an interesting day. I didn't see this one coming, but maybe I'm a fool for expecting the market not to rally 1% after selling off 1% for the first time in forever. But anyhow, that's why I don't swing trade. I don't try to make multi-day plays and bets on bottoms and tops. But I will tell you, it was a unique day. And before I get into that, let's talk about what Monday might bring us. I thought would be interesting to share would be simply the results of fading gaps after a 1% higher close. We closed up 1% above the close of yesterday, and we're above the 10 and 200-day moving averages. See the 10 there, bounced right off that 20. Has a nice sample size and a very consistent and impressive historical return. 1% higher after closing above the 10 and 200-day moving average. I'll use gap trader, my back testing tool. And there you go. Odds favor a gap down slightly, but this has happened 157 times. Not all that unusual from a historical perspective. About 7-8% of the time, maybe not quite that. 5% of the time in the past 10 years. Get a day like this, 1 in 20. So not unheard of. Using an end of the day stop, it showed greater than 80% odds. In fact, 85% for shorting an up gap. That's 15% greater than the average gap fade setup. What's interesting, or most interesting to this one, to me, is that if you don't fill the gap, those 18% of the times that it does not, look at the average loser. It tends to trend. That equals 11 points right there. 5,500 divided by 500, 11-point move down is the average loser. Now, there's one big one, 26 here, but still, take that out. That's still a pretty sizable number and bigger than the largest rally to the upside. So odds favor the bigger move to the downside, but odds also favor gap fill in either direction. Let's look at the performance curve. That's pretty solid right there. Nice steady curve. So after another consolidation day, expect or after a trend day, expect consolidation. I'll rerun these numbers for our members looking at a variety of things, such as the 10-day moving average up straddle, now that we closed above the 10-day. Oh, a back-to-back 1% moves, right? Down 1%, then up 1%. Mondays in November, and so on. So next week ought to be interesting. All right, let's get into today's action. That's not it. That's my new website, though. Some data there. Odds favored 55% chance of closing higher today in the S&P based upon where it opened. That's closing odds. That this will be built into the Master the Gap site for our members and made available both for free. We have some great data for free, and if you want to do a subscription, you can also subscribe to this detailed look. And I honestly did not mean to show you that. Let me get you to the right place. That site will be live within a week or so. Certainly before Vegas, because I'm doing a 4-hour workshop on it. So wish me luck. It's going to be good. We got some great information. It should be a great tool, low cost. In fact, if you sign up for my 4-hour workshop, you'll get a year of which cost about $300, $295 I think, or maybe $275. You'll get a year of membership to closing odds at no charge. Right. Let's go down to the worksheet first. So we bounced around. It was jobs report day. That's what this shows here. Odds favor shorting an up gap, not buying a down gap, and market was just pretty choppy. We had some pressures in both directions. Down gap after bearish outside days, 50-50 on a small sample size. 10-day moving average down straddle, slightly attractive. Watch spread 7-day, very attractive, and gapping between the close and the low, slightly attractive. Between the high and the close, slightly attractive. So not a whole lot to go on there. The problem we ended up with was the following. The ES opened in a strong zone, down a couple points. Right, see the strong data here? So it looks good there. Dow was not confirming. It also opened in actually, it opened pretty much, let me remember. Oh, no, it was open in, I think it opened in the DL zone. Yes, it opened in the DL zone. So that was a 50-50 trade. A little bit of a concern. And then the NASDAQ and the Russell ended up opening up in the DOC zone with good odds for gap fills. So if the NASDAQ fills its gap, what's going to happen? Generally, you can expect it to push the ES and the Dow further down against your trade. So I don't like those opposing directions. I will trade when the NASDAQ is gapping up a little. It's a pretty significant gap today. And then the Russell was also in the DOC zone. Spider showed more of the same. Hey, Ollie, what you doing, buddy? Huh? You need to go outside? Yeah. Can you sneeze for me? Y'all listen. My kids taught my dog to sneeze. If I had food, he'll definitely do it. Quick, can you sneeze? Louder. Sneeze. I don't know if you could hear that or not. He just sneezed twice. Little small sneezes. Sort of cute until he does about 5 times on you, hoping to get a snack. But I digress. All right, but it is Friday, so I'll cut myself some slack. The ETFs, good numbers there in the Spider. Dow not as good. Q's showing decent numbers, slightly attractive for the gap to fill, and the Russell actually favoring gap fill there. So it was just too mixed. Lots of things to look at. Ultimately, it was just markets were bouncing around too much to show you would just confuse you. The bottom line is the guides were neutral to slightly attractive if they were opening in the same direction. And we had these factors that were from here in the worksheet that were basically mixed in both directions. So bottom line for me, small gap size, on the fence kind of trade, risking 5 to make 1, not my favorite thing to do. So to do that, I wanted to make sure all 4 futures were trading in the same direction they open. It was at least a point of opportunity. If so, I was going to hold some for the extended target, which would increase my win size. But as it turned out, the ES, you can't see it. It opened right underneath. Let me turn those lines off. 15-minute and first hour lines. There you go. Sure enough, see there opens a white line there, 1743 1/4. So it actually had 2 1/4 points going for gap fill. The 4 p.m. close was only 44.50, so only had 1 1/4 points. It turned out it went on to hit extended target and kept on trucking today. A little bit unusual, even though my closing odds did show a 55% chance of it gapping up. Everything pretty much did the same. Russell did not fill, a little bit surprising. NASDAQ, if it filled, barely did so. And the Dow did fill. So I passed on it. Probably the monthly jobs report is generally risky on markets that test the lows. But let me show you the 15-minute range, guys. Check out these numbers. Low fade, right at my criteria. I'm looking for 55 and 1.1 today. 15-minute range, guys. Basically check in the Dow. Favored in the NASDAQ, not quite meeting my criteria. Favoring the low breakout in the Russell, so I did not support it. ETFs, Spider leaned that way, Diamonds leaned that way, Q's favored it, and even the Russell met my criteria. So all in all, clearly favoring the low fade, but with the low breakout from our advanced studies not being favored on this day, and this action being strong cross currents, I passed on it, and it didn't technically meet my criteria. That was awfully close. Passed on it, sure if it didn't come down to the tick, test it, and rally hard. So a little disappointing. I did a discretionary trade during the doldrums, a little bit unusual for me, but I did, thinking we may have topped out during lunch, which will often happen in this particular zone under similar scenarios. And I lost I lost 4 points. That was a tiny size. 4 points. Got stopped right at the high of that wick. I thought I'd been buffaloed, but ultimately rallied later. So a little frustrating, but for the most part, pretty quiet week for me, and setting up some good movement next week. So looking forward to that, and looking forward to the weekend. Hope you have a good one, and we'll see you Monday. Take care.